All right, we're talking about back testing today. I think this is some of our most important work. I don't know if this will, thrill the whole audience here with excitement, but people that want to know the details, this is a good video for you. I will give you the upfront bottom line for the people who just want to watch for a minute or two. And basically, what we did is we went back as many quarters as we have data for that's readily available, easily to get. It's 6 years, okay? And we would go back every single one of those quarters, rank the companies in the S&P 500 according to their cash flow IRR return, the way we calculate return on invested capital. Literally line them up, and then calculate the first quarter, the second quarter, the third quarter, and the fourth quarter for the next quarter. How the stock did for that next quarter after the observation of cash flow IRR. Okay, and just did that every single quarter for 24 quarters, and actually it's 23 quarters, but let's not get too technical. And it completely outperformed, exactly in line the way we want it. The first quartile of cash flow IRR was the best performer in the market. The second quartile was the second best. The third was the third, and the fourth was the fourth. Just the way you would expect it to be. Unbelievable. Super pleased with these results. By the way, I've done this kind of test many times. But this is the most robust quarter by quarter by quarter by quarter period. I've done them one-off many times, and it is rarely failed. There are a couple of quarters here and there where it flips, and that's when speculation is rampant or something just weird going on in the marketplace. But generally speaking, by the top quartile of companies in their according to their cash flow IRR, that's how it works. The best return on capital companies. Okay, that's the short version. If you want to tune out, that's fine. If you want details, they're coming up. All right, here we go. All right, we're going to jump into this product called Quick Portfolio. And Quick Portfolio allows you to develop a watch list or a portfolio, really the same thing to me, and look at a ton of variables. I mean, I'm just going to scroll a little bit, and you see a lot of variables. This is mostly a cash flow IRR section, then growth in revenue and capital and dividends and stock market performance, and this actually goes on and on. We have thousands of pieces of data that we could put in here, but I try and focus. And this one I developed specifically for testing if ranking the cash flow IRR was the right thing to do. So I'm going to show you how we do this. Okay, so I'm going to rank it on cash flow IRR 1 quarter ago, and then see how it did in the next 90 days of the actual stock. So here's the rank, and there it goes. It just ranked everything. Netflix is the #1 cash flow IRR company. Netflix is a funny company. I admit that it's hard to believe that they have the highest return, but they have some really strange accounting, and we're trying to use cash on cash. But anyways, that's a whole other video. I didn't want to make any exceptions, so I just wanted it to be what it is. Okay, and then Roper, S&P Global, Discovery. We actually have Discovery twice because there's Class A shares, MasterCard, etc. Okay, that's just for this 1 quarter ago. And now we want to see how well it did in the market. So I have a little bit of a graphic to illustrate that a little bit better, and that's this cash flow IRR shift. So here's kind of some of the same data. It might have been from a slightly different day or something, but Netflix, Roper, SPGI, or S&P Global, and you look at the cash flow IRR -1. So then we're going to see how the stock did. That's why we got this little squiggle arrow. Then see how well it did. Because 90 days ago or last quarter, we would have had this data, but we wouldn't have had this. We wanted to see, did it work? It's kind of like a blind test, right? We want it to be real. I don't want it to be in the same time frame. I want it to be before, and then let the stocks run out for a bit of time and see if it works. Okay, and that's what we're doing. All right, so we got that concept. So I just ranked this full database on the last fiscal quarter -1. And then, so we want to look at the return in the last quarter, or last 3 months, same thing. And that's going to be, I'm just scrolling out so many different columns, and I actually have it highlighted in yellow. So you see, actually, Netflix didn't do all that great. Even though it was the #1 rank, it lost 14%. Roper lost 1.2%. However, S&P Global was up 14. Okay, et cetera, et cetera, et cetera. We go down, and we're going to look at that quarter, and we're going to look at the second quarter, and we're going to tally up that data. So let me introduce the concept of quartiles, excuse me, which most people would know, especially if you're in this business, but I just want to go over it anyways. So quartiles, we have about 400 companies, excuse me, in the S&P 500, because we had to eliminate some of the financial stuff because it doesn't work well with our cash flow IRR. And for illustration purposes, a quartile of 400 companies would be the top 100, right? And then 101 to 200 would be the next. For illustration purposes, though, I couldn't put 100 stocks on the page, so I just did, I think it's 38 stocks. So the top 38 is the first quartile, then you go down, and the next 38 is the next quartile. And they're ranked on this column here, which is cash flow IRR, 1 quarter ago. And then this is the stock return. So Netflix was -6 in this case, so I clearly used data from a few days ago or something like that. And then we want to take that average return, because again, not every company is up in the first quarter. In fact, well, this one's a beautiful one, Accenture, which is a great company, by the way, up 34% in the last quarter. Beautiful. In the last 90 days. However, this F5 networks, even though it ranked high, it was down 30%. It happens. Okay? So we ranked that first quarter in this particular example, or first quartile, and it was a 4.9%. The next quartile was 2.4, and then the next quartile was 1.3, and I don't have the fourth quartile available here. So I do want to introduce the concept of rolling quartiles, okay? Because I like the rolling quartiles. So it means, yes, there's the first quartile here. I'll highlight it, and then the next quartile would be right after that. But you can take a little bit of an interim step and just say, well, let's take out Netflix, but pick up the next one in order. And it happens to be Allergan. And then the next portfolio is drop the top 2, so Netflix and Roper, and pick up Thermo Scientific. And then I just show another example. You know, what is this? The 15th portfolio. You take the top 15 out, pick up 15 more below it, and then you just keep rolling these quarters, and then get your data that way. I really like this chart because it comes out awesome. So I'm going to show you that chart. This is in real time. I just ranked them, and now I want to look at I ranked them from cash flow IRR 1 month ago or 1 quarter ago, and then I observe the return on that rolling quartile basis, and this is that yellow kind of yellow-orangey chart up there. And the very first portfolio was the very best one. I mean, that doesn't always work that beautifully. This happens to be a really good quarter, and you can see slowly as we roll those quartiles, they get worse and worse. There's a little bumps here and there, like this is an odd one. Way down near the bottom quartile, some of these portfolios actually performed okay, but then the last few, and virtually the last bar is the last quartile, and it was the worst portfolio. So that is a particularly good quarter. It doesn't always work out that well. In fact, I'm going to do I'll do the next couple of quartiles for you. Or next couple of quarters, and then observe the quartiles. So we have to rank them. Now I'm going to go 2 quarters back and observe what it did for between 120 and 90 days. That quartile. So hold on 1 second. There's a lot of data here. It slows down your scrolling. You know, there's a bit of a buffer, and I've just buffered right by where I wanted to go. Okay, we're getting close. Okay, so I just ranked it 1 quarter ago. Now I'm ranking it 2 quarters ago. Just the ranking function is quite quick. But now I need to observe, also pull that 1 quarter back, kind of like this guy here. So we just did this one. Now we're going to do this one. Okay. I still have one little quick adjustment in our data is to tell it which column to look at. And basically, I have this set up to, we were looking at column BU, so now we would look one column before that, which would be BT, and this is the data we want. And okay, completely different looking chart. Very interesting in that the top portfolios ranked again by CashFIRR were some of the best ones, but it didn't, there's a couple of dips here and there. Actually, somewhere in the middle here is actually the best portfolio. So roughly the second quartile might have been better in this particular case. Kind of went down in those other portfolios, and then a little bit of a bump at the very end. Okay, so we do this. Obviously, we keep doing it. Let's do one more, just so you get the idea. As I said, this is for the keeners that want to go through all of this. I actually find it really fascinating. I love ranking it and then seeing the quartile performance. So 3 quarters ago, and largest to smallest. Okay, so by the way, it doesn't change the rankings all that much each quarter. And then we got to tell it what column, so one more column back. So we were in column BT, yeah, so BS is the one we want. And again, that's scrolling, BS. And what results do we get? Oh, okay, so this is a bad quarter for everybody. I'm glad this came up. I literally did not plan this, and I'm glad this came up. So yes, it was a lousy quarter. Whew, that must have been, well, 2 quarters ago. 3 quarters ago was our observation. Somewhere in the Christmas time frame, because there was, yeah, I think so. Anyways, I'm not sure. I have to figure that out. Brutal, though. Brutal. However, the best portfolios were still, although down, this is negative. It's, I don't know, you can see that on the chart, but it's negative. Down 12%. Whew. However, some of these other ones were down more. So, the tendency, it's not perfect, is the lower ranked CashFIRR companies did worse. Okay, so we're going to do this for 24 quarters now and record that data. And we've done that. And we just use the quartile data. We don't go every single portfolio. And here's that data, and this is interesting. The very 23 quarters ago, the first period we have data for, the first quartile earned a 6.8% return, but the fourth quartile also earned a 6.8, so tied, no big deal. Next quarter, the first quartile did worse than the fourth quartile. In fact, it's completely flipped on its head, right? This is not what we wanted to see. But then it reverses itself to what we do want it to see. The first quartile outperformed in that particular quarter, and the fourth quarter was the worst. Perfect. That's what we want to see. But you got to do this over time. Otherwise, just doing it one period here and there and saying, oh, yeah, it works. No, you got to be methodical about it. And we're being very methodical. And what's the net result? The net result is this. Over time, the top quartile in this time frame, 5 3/4 of years ago, almost 6, we have the top quartile earning a 14.2% return over that time. So $1 would have accumulated into almost $2.20. So more than double in less than 6 years. That's awesome. Second quartile was second, third quartile was indeed third, and the fourth quartile was indeed fourth, only earning at 3.3%. So stop making your life hard. Fish in the top quartile of CashFIRR, or return on invested capital. It doesn't matter how you calculate it, though. I've done these tests with ROE. It doesn't come out as good. It always comes out better with our CashFIRR. So by all means, come see us. We will help you get these top quartile returns just by helping you with better metrics.